London, 1889. The British Empire controls 1/4 of the Earth's landmass. Its gold standard is the heartbeat of global commerce. Every currency from New York to Tokyo derives its value from London's promise. And at the center of this financial solar system sits Baring Brothers, the most prestigious merchant bank in human history. They financed the Louisiana Purchase. They funded the Napoleonic Wars. They built railways across 5 continents. But on November 8, 1890, 3 partners walk into a mahogany-paneled room on Bishopsgate Street and discover something that will nearly destroy the British Empire, 24 years before a single bullet is fired in World War I. In their vault sit £21 million worth of Argentine railway bonds, beautiful certificates, embossed with government seals, legally binding promises from the Republic of Argentina. But there's a problem. Argentina is bankrupt. The bonds are worthless. And Baring Brothers has been lying about it for 3 years. Within 7 days, the Bank of England will organize the first too-big-to-fail bailout in modern history. Within 7 weeks, Britain's gold reserves will drop to levels that would make a modern central banker physically ill. Within 7 months, the myth of British financial invincibility, the psychological foundation of imperial power, will be dead. This is not a story about a bank that failed. This is a story about the moment the British Empire looked in the mirror and saw a corpse. The crisis was contained. The bailout worked. To understand how close Britain came to annihilation in 1890, you need to understand what London actually was. Not a city, not a capital, a religion. The Church of the Gold Standard. Every major transaction on Earth's cotton from Alabama, silk from Shanghai, wheat from Ontario, was priced in pounds sterling, and pounds sterling meant one thing: gold. 1 pound equaled 113 grains of pure gold, guaranteed by the Bank of England. This wasn't economics. This was theology. The promise was simple: bring your paper to London and we will give you metal. No questions asked, no limits, forever. And for 80 years, Britain kept that promise. The result was the most powerful financial weapon ever created: credibility. When Britain said a debt would be paid, the world believed it. When British banks guaranteed a loan, investors lined up. And no institution had more credibility than Baring Brothers. Founded in 1762, Baring wasn't just a bank, it was a dynasty. They didn't have clients, they had sovereigns. The Tsar of Russia banked with Baring. The French government negotiated through Baring. The United States Congress borrowed from Baring to buy Louisiana from Napoleon. If you were a nation and you needed capital, you didn't go to a bank. You went to 8 Bishopsgate Street and you asked the Baring family for permission to exist in the modern economy. But in the 1880s, something changed. Competition. German banks, flush with unification capital, started offering cheaper loans. American investment houses began financing their own railroads. French syndicates underwrote bonds that Baring used to monopolize. And Baring Brothers made a decision that would nearly kill the British Empire. They would chase yield. They would take risks their grandfathers would have called insane, and they found their casino in South America. Argentina, a nation with infinite beef, infinite wheat, infinite potential, and infinite appetite for British loans to build railways into that potential. Between 1880 and 1889, Baring Brothers lent Argentina over £40 million. To put that in perspective, that's roughly equivalent to £200 billion in today's money. Lent to a nation whose government had defaulted 3 times in the previous 50 years. Lent to finance railways that went nowhere profitable. Lent on the promise that commodity prices would rise forever. But here's the thing about lending to governments. If they don't pay you back, you can't repossess a railway. You can't foreclose on a province. You can only pray they care about their reputation enough to keep paying. And by 1889, Argentina had stopped caring. Commodity prices were collapsing. The government was printing money to pay civil servants, and Baring Brothers was sitting on a mountain of bonds that no one, absolutely no one, wanted to buy. But they couldn't admit it, because if Baring Brothers admitted insolvency, the entire system would question the one thing that made British finance work: trust. The stakes weren't just one bank. If Baring failed, every foreign investor would ask the same question: if London can't save Baring, Can London save itself? And the answer, the terrifying, unthinkable answer, was no. Britain's total gold reserves in 1890 were approximately £28 million. Baring's exposure to Argentina was £21 million. One bank, one country. 3/4 of the British Empire's liquidity. Walk through the city of London in the summer of 1889. Threadneedle Street gleams. The Royal Exchange bustles with merchants in silk top hats. Horse-drawn carriages clatter past the Bank of England's neoclassical columns. Every surface screams permanence. Marble, granite, gold leaf on the signs of counting houses that have stood for generations. This is the visual language of empire. But step inside 8 Bishopsgate Street, into the private offices of Baring Brothers, and you see something different. Ledgers, stacks of them, each page filled with entries for Argentine railway bonds, Argentine government securities, Argentine provincial debt, £21 million worth of paper promises, beautiful documents, stamped with official seals, signed by ministers. Legal obligations of a sovereign nation, but there's a problem that appears in the margins notes written in pencil by junior clerks who actually check the numbers. Buenos Aires wheat shipments down 40% from projection. Cordoba railway revenue insufficient to cover bond interest. Provincial government payment delayed 3rd consecutive quarter. These aren't annotations about a struggling investment. These are obituaries. By mid-1889, Baring's senior partners know the truth. Argentina cannot pay. The railways they finance don't generate enough revenue. The land values they projected never materialized. The commodity boom they bet everything on is over. But in the mahogany boardroom where decisions are made, a different conversation is happening. Lord Revelstoke Edward Baring, the firm's chairman, sits at the head of the table. He is aristocracy. His family name opens doors to Buckingham Palace, and he has a solution to the Argentine problem. We extend the loan terms, he announces. We restructure the debt. We give Buenos Aires more time. One of the junior partners, a man whose name history has forgotten, raises his hand. Sir, the mathematics don't support restructuring. If we extend, we're simply delaying insolvency. Revelstoke's response is not economic, it's social. We are Baring Brothers. We do not acknowledge insolvency. We manage liquidity challenges until conditions improve. This is the moment the cancer becomes terminal. Not because of the bad debt, because of the refusal to admit the bad debt exists. And so the lie compounds. Every quarter, Baring Brothers pays dividends to its partners. Generous dividends. Dividends that announce to the City of London, we are profitable, we are stable, we are Baring Brothers. But the money funding those dividends isn't coming from profits. It's coming from new loans. Baring is borrowing short-term money from other banks at interest to pay dividends that maintain the illusion of health. This is the financial equivalent of using a credit card to make your mortgage payment. And every bank in London is watching. The competitors see Baring's dividend announcements in the financial press. They assume business is booming, so they lend to Baring without hesitation. After all, this is Baring Brothers, the house that financed empires. What they don't see is the hemorrhaging. By November 1889, Baring's actual liquid reserves, the cash they can access immediately, have dropped to less than £2 million. But their obligations, the promises they've made to depositors, creditors, and bondholders, exceed £40 million. This is a liquidity ratio that would trigger regulatory seizure in any modern financial system. But Victorian London has no regulators, no stress tests, no transparency requirements, just reputation, and reputation is a lagging indicator. It tells you where you were, not where you are. Meanwhile, in Buenos Aires, the situation is accelerating toward catastrophe. The Argentine government is printing pesos to pay civil servants. Inflation is spiking. Foreign investors are quietly exiting positions, and the railways, those gleaming symbols of progress that Baring financed, are running half-empty trains through provinces where land prices have collapsed. One of Baring's agents in Buenos Aires sends a telegram in August 1889. It's brief. Recommend immediate withdrawal from all new Argentine commitments. Revenue projections unattainable. Default probable within 18 months. The telegram reaches London. It's read by Revelstoke, and it's filed away. Because acknowledging it would require action, and action would require admitting error. And admitting error would destroy the one asset Baring Brothers still has, the illusion of infallibility. So the charade continues. Champagne lunches at the Savoy, box seats at Covent Garden, donations to the Conservative Party, every public gesture designed to communicate one message: we are untouchable. But in the counting houses and the quiet offices where clerks actually reconcile the numbers, a different reality is crystallizing. Baring Brothers is already dead. They just haven't stopped moving yet. The visible empire, the marble facades, the aristocratic partners, the century of credibility is a monument built on top of a sinkhole. And that sinkhole is about to open, because in November 1890, something happens that no amount of social capital can prevent. Someone asks to see the books. November 8th, 1890. A Saturday morning. London is quiet. The financial district is closed for the weekend, but inside 8 Bishopsgate Street, 3 men are gathered in a room that smells of leather and cigar smoke. Lord Revelstoke, John Baring, his cousin, and Thomas Baring, the firm's most senior accountant. On the table between them sits a telegram from Buenos Aires. It arrived Friday evening, too late to discuss. It's from Argentina's finance minister. 6 words: cannot meet January bond obligations. This isn't a request for restructuring. This isn't a negotiation. This is a declaration of default, and it triggers a cascade of realizations that will nearly destroy the British financial system within 72 hours. Thomas Baring, the accountant, speaks first. If Argentina defaults in January, we cannot sell any of the £21 million in bonds we're holding, which means we cannot access liquidity, which means we cannot meet our obligations to the other banks who've lent to us. Revelstoke interrupts. How much have we borrowed against the Argentine portfolio? Thomas checks his ledger. Approximately £17 million, sir. From whom? Everyone. Silence. Because everyone isn't hyperbole. In the preceding 12 months, Baring Brothers has borrowed money from nearly every major bank in London to cover the gap between their illiquid assets and their immediate obligations. The Bank of England, Rothschild & Sons, Glyn, Mills & Co. Smith, Payne & Smiths, even smaller provincial banks. All of them lent to Baring because Baring's name was a guarantee. But now, Thomas Baring is explaining the mathematics of contagion. If we default, every bank that lent to us will demand immediate repayment from their other borrowers to cover the loss, which will force liquidations across the market, which will crash asset prices, which will trigger margin calls on leveraged positions, which will. Revelstoke holds up his hand. How much gold does the Bank of England hold in reserve? Approximately £28 million, sir. And our total exposure to Argentina? £21 million. The room goes silent again, because everyone in that room suddenly understands the butterfly effect they've created. One bank's insolvency isn't just a private failure. It's a systemic threat to the gold standard itself. If Baring defaults, the other banks will panic. They'll demand their deposits back from the Bank of England. They'll convert pounds into gold and ship it to safer jurisdictions. Paris, Berlin, New York. And Britain's gold reserves, the £28 million that backs the entire imperial currency system, will evaporate, not over years, over weeks, maybe days. John Baring asked the question no one wants to answer. What happens if the Bank of England's gold reserves drop below the threshold for convertibility? Thomas Baring doesn't hesitate. Britain suspends the gold standard, which means the pound becomes a fiat currency backed by nothing but trust, which means every foreign holder of British debt will sell immediately, which means the empire loses access to international credit markets, which means we cannot finance the military, the colonies, or the government. This is the nightmare scenario, not a recession, not a financial crisis, a civilizational collapse. The British Empire built on credit, sustained by trust, powered by the gold standard reduced to a second-rate power overnight, all because of Argentine railway bonds that no one can sell. Revelstoke stands. He walks to the window. Outside, London looks eternal. St. Paul's Cathedral in the distance, the Thames flowing like it has for 1,000 years. But he's watching an empire that exists only because people believe it exists, and belief is fragile. He turns back to his cousins. We informed the Bank of England on Monday morning. We request emergency liquidity support. And we pray they have a solution. John Baring asks the final question, what if they don't? Revelstoke doesn't answer, because there is no answer. If the Bank of England cannot save Baring Brothers, then the financial architecture of the British Empire will collapse before Christmas. One bank, one country, one default. And suddenly, the most powerful empire in human history is 72 hours away from insolvency. The telegram from Buenos Aires sits on the table. 6 words, but those 6 words have just revealed something terrifying. The British Empire's gold reserves cannot cover a single major financial institution's failure. London has been running a fractional reserve system on an imperial scale. The marble palaces, the aristocratic bankers, the century of credibility, all of it was a confidence game. And on November 8, 1890, in a quiet room on Bishopsgate Street, 3 men realized the game is over. The only question now is whether anyone else will figure it out before they can organize a rescue. Because if the public panics before the bailout is arranged, there won't be enough gold in England to prevent a total systemic collapse. The countdown has begun. To understand how Baring Brothers, the most prestigious bank in the world, destroyed itself, you need to understand a paradox. The shoemaker's paradox. Imagine a master shoemaker in Victorian London. He starts his career making boots for laborers. Solid work, reliable income, modest profit margins. But his craftsmanship is exceptional, so his reputation grows. Soon he's making shoes for merchants, then lawyers, then members of parliament, and finally the ultimate achievement, he receives a commission from a duke, custom riding boots, the finest leather, gold buckles. The duke is delighted. He pays immediately. He tells his aristocratic friends, and suddenly the shoemaker's client list becomes a who's who of British nobility. But here's where the paradox emerges. The shoemaker's costs have skyrocketed. He needs a prestigious workshop in Mayfair instead of Cheapside. He needs rare materials that take months to source. He needs assistants who understand aristocratic tastes. But the dukes and earls who commission his work, they pay slowly. Not because they're dishonest, because they're aristocrats. They operate on a different timeline. An invoice that a merchant would pay in 30 days might take a lord 6 months to settle. It's not personal, it's class dynamics, and the shoemaker cannot press them, cannot send collectors, cannot sue, because his entire business model depends on being the shoemaker to the nobility. If he aggressively pursues payment, he loses the social capital that makes his business valuable, so he waits. And while he waits, he takes on more commissions. Because he needs cash flow to cover the costs of the last commissions that haven't been paid yet. This is the trap. The more prestigious his clients become, the more financially precarious his position becomes. Eventually, he's technically insolvent. He owes money to leather suppliers, landlords, and assistants, but his assets, the unpaid commissions from dukes, are theoretically worth a fortune. He just can't access that value, and he cannot admit the problem. Because the moment he admits he's struggling, his entire reputation collapses. No duke wants to wear boots made by a shoemaker who's desperate, so he keeps taking commissions, keeps projecting success, keeps waiting for the aristocrats to pay, until one day, a leather supplier demands immediate payment, and the shoemaker has no cash, and his entire business, built on decades of masterful work, implodes in 72 hours. This is not a metaphor. This is exactly what happened to Baring Brothers. Phase 1, conservative success, 1820s, 1860s. Baring Brothers built its reputation by lending to stable, creditworthy borrowers. The United States government, the French government after Napoleon, the Russian Tsar. These were entities that paid reliably. The profit margins were modest, 2% to 4% annual returns, but the risk was minimal. And in finance, low risk attracts prestige. Prestige attracts more capital. More capital means more deals. And for 50 years, this model worked perfectly. Baring Brothers became the financial equivalent of our master shoemaker, known for quality, reliability, and association with power. Phase 2, the competition trap, 1870s, 1880s. But by the 1870s, the world changed. German unification created new banks flush with capital. American investment houses began financing their own infrastructure. The British Empire's monopoly on global finance was eroding. and Baring Brothers faced a choice: accept lower market share and maintain conservative standards, or chase yield in riskier markets. They chose risk. South America became their new frontier. Argentina, specifically. A nation with enormous potential but catastrophic governance. But here's the psychological trap that mirrors our shoemaker. Lending to Argentina was prestigious. It meant Baring Brothers was still financing nations, still operating at the highest level of global finance. And prestige became the product. Not profit, not risk-adjusted returns. Prestige. When Lord Revelstoke attended dinners at Buckingham Palace, he didn't talk about the 3% return on a Canadian railway bond. He talked about financing the modernization of Buenos Aires. The social capital was intoxicating. And like our shoemaker, Baring Brothers began prioritizing the appearance of success over the mathematics of success. Phase 3. The aristocratic payment problem, 1885 to 1889. Here's where the analogy becomes literal. Argentina, like our Duke, operated on a different timeline. Bond payments were delayed for administrative reasons. Restructurings were proposed instead of defaults. And Baring Brothers couldn't press too hard, because if they declared Argentina in default, they would have to write down £21 million in assets, which would reveal insolvency, which would destroy their reputation, which would end their ability to attract new capital. So they did what our shoemaker did. They took on more Argentine debt, not because the investment was sound, but because they needed the fees from issuing new bonds to cover the losses from the old bonds that weren't being repaid. This is the debt spiral, each new loan creating a temporary illusion of liquidity while deepening the fundamental insolvency. And the entire time, they maintained the facade. Paid dividends to partners, hosted lavish dinners, announced new deals in the financial press, because the moment they admitted struggle, the game was over. The macro translation, the Imperial shoemaker, now scaled this dynamic to an empire. Britain is the shoemaker. Argentina is the Duke. And the workshop in Mayfair is the entire city of London. Britain has built its financial dominance on a reputation for reliability, but that reputation requires constantly demonstrating engagement with prestigious, high-stakes deals. Argentina is prestigious, a nation of vast resources, European culture, and enormous growth potential. Financing Argentina signals that Britain is still the world's indispensable financial power, but Argentina doesn't pay reliably. Its politics are unstable. Its revenues are volatile. Its commitment to debt service is conditional. And Britain cannot press too hard, because if Argentina defaults and Britain cannot absorb the loss, the entire world will question London's solvency. So Britain, through Baring Brothers, keeps lending, keeps restructuring, keeps pretending the debt is performing, until November 1890, when the telegram arrives. Cannot meet January bond obligations. This is the leather supplier demanding immediate payment, and Britain has no cash. The prestige trap revealed. Here's the final layer of the paradox. The shoemaker's insolvency was hidden by his prestigious client list. Baring Brothers' insolvency was hidden by its prestigious deal flow. But prestige is a lagging indicator. It tells you where you were, not where you are. By the time people realize the shoemaker is bankrupt, he's been bankrupt for years. By the time the Bank of England realizes Baring Brothers is insolvent, the contagion risk is already systemic. The paradox is complete. Success created reputation. Reputation created access to prestigious deals. Prestigious deals created unsustainable risk. Unsustainable risk created insolvency. But insolvency could not be admitted because it would destroy the reputation that made the business possible. So the lie compounded until the mathematics became undeniable. And by then, it wasn't just a shoemaker going bankrupt. It was the financial credibility of the British Empire standing on the edge of a cliff. One bank, one analogy, one question. How do you save a shoemaker when his entire workshop is the empire itself? The city of London in 1890-30 was not just a financial district. It was a priesthood, and the priests had one sacred duty: maintain the illusion of eternal stability. This wasn't cynicism, this was doctrine, because British finance didn't operate on collateral. It operated on belief. The entire system, the global gold standard, the imperial currency, The network of credit that financed 5 continents rested on one psychological foundation: the belief that London would never fail, not couldn't fail, would never fail. And the high priests of this religion were the senior partners of the great merchant banks: Baring Brothers, Rothschild and Sons, Brown, Shipley and Co. These weren't just businesses. They were institutions that predated most European governments, and they had a culture that punished doubt. Let me show you how this worked. The psychological architecture of denial. Inside Baring Brothers, there was a hierarchy. At the top, Lord Revelstoke and the senior partners, aristocrats, educated at Eton and Oxford, connected to Parliament and the royal family. In the middle, professional bankers, men who understood mathematics but also understood their place. At the bottom, clerks and accountants, the people who actually reconciled the numbers every night. And by 1888, those clerks knew the truth. The Argentine bonds were worthless. The revenue projections were fiction. The asset valuations were fantasy. But when a junior clerk raised concerns, he wasn't celebrated for diligence. He was ostracized for pessimism, because pessimism was a virus in this system. If one person doubted, others might doubt. If others doubted, clients might doubt. If clients doubted, the entire edifice collapsed. So doubt was punished. Not through formal discipline, through social exclusion. The clerk who questioned Argentine bond valuations found himself uninvited to the partnership dinners. His memos were acknowledged but never acted upon. His career trajectory quietly shifted from rising talent to solid but unambitious. The message was clear: we don't reward people who see problems. We reward people who solve them quietly. And solving them quietly meant pretending they didn't exist. The cult of British financial exceptionalism. But this wasn't unique to Baring Brothers. This was systemic across the city of London. There was a cultural belief, unspoken but absolute, that British finance was categorically different from continental finance. When French banks failed, it was because the French were volatile. When American banks collapsed, it was because Americans were reckless. But British banks didn't fail. This wasn't arrogance. This was identity. Being a banker in Victorian London meant inheriting a legacy of stability that stretched back to the founding of the Bank of England in 1694. Nearly 200 years of unbroken reliability. 2 centuries of honoring convertibility. 2 centuries of never suspending the gold standard during peacetime. This history wasn't just a fact. It was a psychological shield. And anyone who suggested that British banks could fail was attacking not just an institution, but a national myth. The evidence suppression machine. By 1889, Baring Brothers had conducted 3 internal audits of their Argentine exposure. All 3 audits reached the same conclusion: the portfolio was impaired, restructuring was necessary, and continuing to lend was financial suicide. All 3 audits were read by senior partners, and all 3 audits were filed away without action. Why? Because acting on them would require admitting error. And admitting error would require explaining the error to the other banks, and explaining to the other banks would trigger a liquidity crisis. So the solution was simple: suppress the evidence until conditions improved. This wasn't fraud in the legal sense. This was organizational delusion in the psychological sense. The senior partners genuinely believed that if they maintained confidence long enough, Argentina would recover, commodity prices would rebound, railways would become profitable, and the bonds would regain their value. This is the gambler's fallacy applied to imperial finance. We're too deep to quit now. The next hand will turn it around. We just need to maintain our position until the market recovers. But markets don't reward patience when the underlying asset is structurally worthless, and by November 1890, the underlying asset, Argentine economic competence, had been structurally worthless for 5 years. The idol of continuity. Here's the most insidious part of the prestige trap. Baring Brothers continued paying dividends throughout 1888, 1889, and into 1899. Generous dividends. Dividends that announced to the world, we are profitable, business is excellent. But the money funding those dividends wasn't profit. It was borrowed capital. Baring was taking short-term loans from other banks at interest and using that money to pay dividends to partners. This is financial necromancy, animating a corpse with borrowed electricity, but it worked. Because the dividend payments reinforced the narrative of health. Other banks saw the dividends and thought Baring is thriving. Investors saw the dividends and thought Baring is safe. Even Baring's own junior partners saw the dividends and assumed the Argentine concerns were overblown. After all, a failing bank doesn't pay dividends, except this one did. Because not paying dividends would have triggered the very panic they were trying to prevent. The dividend wasn't a distribution of profit. It was a ransom payment to keep the illusion alive. The social architecture of silence. But the culture of denial extended beyond Baring Brothers. The Bank of England knew Baring was struggling. They didn't know the full extent, but they knew enough to be concerned. Yet the bank's governor, William Lidderdale, said nothing publicly. Why? Because public concern would trigger panic. And panic was contagious. If the Bank of England expressed doubt about Baring Brothers, every depositor in London would rush to withdraw their funds, not just from Baring, from every bank. Because if Baring could fail, anyone could fail. So Lidderdale played along. He attended dinners with Revelstoke. He made polite conversation about market conditions. He maintained the performance of normalcy, even as he privately instructed his staff to prepare contingency plans for a Baring collapse. This is the central paradox of systemic risk. The people who see the problem most clearly are the same people who cannot speak about it, because speaking about it creates the crisis they're trying to prevent. The cascading lie, private terror, public confidence. By October 1890, the senior leadership of British finance was living in two realities. In public, champagne toasts, confident editorials, parliamentary praise for the soundness of British banking. In private, emergency meetings, desperate letters, and calculations of how quickly gold reserves would evaporate if Baring defaulted. The Bank of England was quietly arranging credit lines with the Bank of France. Rothschild & Sons was privately liquidating positions to build cash reserves, and Baring Brothers was still announcing new deals. Because the moment they stopped announcing deals, everyone would know they were in trouble. So the lie compounded. Every public gesture of confidence required more private desperation. Every dividend payment required more borrowed money. Every reassuring statement to investors required more suppressed evidence, until November 8, 1890. When the telegram from Buenos Aires arrived, and suddenly, the high priests of normalcy had to admit what their clerks had known for 2 years. The idol was hollow, the temple was built on sand, and the British Empire's financial credibility was about to be tested in a way it had never been tested before. Not by war, not by revolution, but by arithmetic. The numbers didn't care about prestige. They didn't care about 2 centuries of stability. They didn't care about the social architecture that punished pessimism. The numbers simply said, Baring Brothers is insolvent. And if Baring Brothers is insolvent, the entire British financial system is 60 hours away from a liquidity crisis that will drain the Bank of England's gold reserves. The priests could no longer maintain the illusion. The only question was whether they could organize a miracle before the congregation realized the temple was empty. November 10, 1819, Monday morning, 10 a.m. The office of the Governor of the Bank of England. William Lidderdale sits behind a mahogany desk that has witnessed a century of financial crises. Across from him, Lord Revelstoke, Edward Baring, 6th-generation banker, educated at Eton, personal friend of the Prince of Wales, a man who has never, in his entire life, been told no by anyone who mattered. Until today. Revelstoke begins with the tone of a man who expects sympathy. Governor, we find ourselves in a temporary liquidity challenge. Lidderdale doesn't respond. He's reading a document that Revelstoke brought. A summary of Baring Brothers' financial position. £21 million in Argentine bonds. £17 million in short-term liabilities to other banks. £2 million in liquid reserves. Lidderdale looks up. This isn't a liquidity challenge. This is insolvency. Revelstoke bristles. With respect, Governor, that's an overstatement. Argentina will resume payments. This is a temporary disruption in a long-term investment. Lidderdale slides a second document across the desk. It's a report from the Bank of England's intelligence office, a detailed analysis of Argentine finances, revenue projections, commodity price trends, provincial government balance sheets, all of it pointing to the same conclusion. Argentina is entering a decade-long depression. Lidderdale taps the document. your temporary disruption is a structural collapse. Argentina cannot pay, will not pay. And you've bet the Bank of England's credibility on a nation that defaulted 3 times in the last 50 years. This is the moment where two worldviews collide. Revelstoke represents the old order, the belief that finance is about relationships, reputation, and social capital, that if you're connected to the right people, if you maintain the right appearance, the numbers will eventually align with the narrative. Lidderdale represents the new order, the cold arithmetic of central banking, the understanding that insolvency doesn't care about bloodlines, that mathematics is not subject to negotiation. Revelstoke tries a different approach. Governor, Baring Brothers has served the empire for over a century. We financed the defeat of Napoleon. We built the railways that connect the colonies. Surely that legacy warrants consideration in this. Temporary. Lidderdale interrupts. Your legacy is exactly why this is a catastrophe. If Baring Brothers were a provincial bank in Manchester, we could let you fail. But you are Baring Brothers. Every foreign investor, every sovereign wealth fund, every treasury on earth watches you as a proxy for British financial health. If you collapse, they don't ask whether you made bad investments. They ask whether London can save its own. The room goes silent because Revelstoke suddenly understands what Lidderdale is telling him. Baring Brothers isn't too big to fail. It's too symbolic to fail. The bank itself is worthless, but the signal its failure would send, that's what threatens the empire. Lidderdale continues and his tone shifts from clinical to furious. Do you understand what you've done? You've taken the credibility of the British Empire, the trust that took 2 centuries to build, and you've bet it on Argentine railway bonds. Bonds that any competent analyst could have told you were worthless in 1887. And now I have to decide whether to drain the Bank of England's reserves to save you or let you fail and watch every foreign depositor pull their gold out of London. Revelstoke's composure finally cracks. What would you have had me do? Admit insolvency? Destroy the firm? And here, Lidderdale delivers the line that will haunt British finance for generations. Yes, you should have admitted insolvency in 1888 when the losses were containable. Instead, you paid dividends with borrowed money, announced new deals you couldn't finance, and turned a £10 million problem into a £21 million catastrophe. You chose vanity over arithmetic, and now the empire pays the price. The class dimension, aristocratic entitlement versus institutional survival. What's happening in this room isn't just a financial negotiation. It's a collision between 2 social classes. Revelstoke is aristocracy. His family name grants him access to royal dinners, parliamentary influence, and social immunity from consequence. In his world, problems are solved through connections, through discretion, through the understanding that gentlemen don't destroy other gentlemen. Lidderdale is professional class. The son of a textile merchant who earned his position through competence, not birthright. In his world, problems are solved through mathematics, through transparency, through the understanding that institutions outlive individuals. And right now, Revelstoke is asking Lidderdale to prioritize personal loyalty over institutional integrity, to save Baring Brothers because of what the name represents, to ignore the numbers because the numbers are socially awkward. But Lidderdale cannot do that, not because he's cruel, because he's responsible for the entire system. If he saves Baring Brothers by draining the Bank of England's reserves, he creates moral hazard. Every other bank will learn the lesson, take reckless risks, because the bank will always bail you out. But if he lets Baring fail, he triggers systemic panic. Foreign investors will flee. The gold standard will collapse, and the empire will lose access to credit markets. This is the central banker's nightmare. Every option is catastrophic. The only question is which catastrophe is more survivable. The breaking point: you've killed the gold standard. Lidderdale stands. He walks to the window overlooking Threadneedle Street. Outside, London continues. Merchants, clerks, carriages, none of them know that the entire financial system is on the edge of collapse. He speaks without turning around. If I organize a bailout, I need total transparency. Every ledger, every asset, every liability. The other banks will only participate if they know the full extent of the damage. Revelstoke hesitates. Because full transparency means admitting the depth of the deception. It means showing Rothschild, Glenn Mills, and every other creditor exactly how long Baring Brothers has been lying. Lidderdale turns back. This is not a negotiation. You have until noon tomorrow to deliver complete financial records. If you refuse, I will let you collapse and use the bank's resources to contain the contagion. If you comply, I will attempt to organize a rescue. But understand this, Lord Revelstoke, even if we save the bank, we cannot save your reputation. Baring Brothers will survive as a legal entity, but the Baring family's control will end. Your firm will be restructured, supervised, and reduced to a shadow of what it was. Revelstoke's voice is barely a whisper. You're destroying us. Lidderdale's response is surgical. No, you destroyed yourselves. I'm simply deciding whether to let your corpse take the empire with it. The human cost, Revelstoke's collapse. What happens next is rarely discussed in economic histories, but the clerks who witnessed it remembered for the rest of their lives. Revelstoke begins to cry, not subtle tears, full, body-shaking sobs, a 62-year-old lord collapsing in the office of the Bank of England. Because in this moment he understands what he's lost. Not just money, identity. His entire life has been defined by one thing, being a Baring. The name that opened every door. The legacy that granted him respect before he'd earned it. And now, that name will be synonymous with catastrophic failure. His children will inherit shame instead of prestige. His grandchildren will grow up hearing whispers. That's the Baring who nearly destroyed the empire. This is the cost of the prestige trap. Not financial ruin. Existential annihilation. Revelstoke leaves the Bank of England at 11:15 a.m. By 30 p.m., he's delivered the financial records. By 5 p.m., Lidderdale is meeting with Rothschild and Sons to organize the Bailout consortium. By midnight, the outline of the rescue is clear. The Bank of England and the major banks will pool £17 million to guarantee Baring's liabilities. But Baring Brothers, the institution, will be dissolved, restructured as a limited liability company, supervised by a committee of creditors. The Baring family will retain a minority stake. But they will never control the firm again. The aristocratic banking dynasty ended not by revolution, but by arithmetic. And the terrifying part? This is just the beginning, because saving Baring Brothers requires draining resources from the rest of the British financial system. And that drain is about to reveal just how fragile the entire empire actually is. November 15, 1890. The consortium is assembled. The Bank of England, Rothschild and Sons, Glenn, Mills and Cober, Brown, Shipley and Co. 12 of London's most powerful financial institutions crammed into the Bank of England's boardroom. They're here for one purpose: to prevent the collapse of the British financial system. William Lidderdale stands at the head of the table. In front of him is a document, the Baring Brothers Guarantee Fund. £17 million, pulled from the reserves of every bank in the room, enough to cover Baring's immediate liabilities and prevent default. Lidderdale speaks. Gentlemen, this is not a commercial transaction. This is an act of systemic preservation. If Baring defaults, every foreign investor will question London's solvency. Gold will flow out of England faster than we can replace it. And the empire will lose the one asset that makes it powerful: financial credibility. One of the Rothschild partners raises his hand. Governor, we're contributing £3 million to this fund. What guarantee do we have that Baring's assets will ever recover value? Lidderdale's answer is blunt. None. The Argentine bonds are worthless. You're not investing, you're paying a ransom. The ransom is £17 million. The hostage is the British Empire. The room goes silent, because everyone understands what's actually happening. This isn't a bailout. This is a payday loan at an imperial scale. The emergency bailout, Britain's first too-big-to-fail moment. The mechanics are simple but devastating. Each bank contributes a portion of its liquid reserves to guarantee Baring's debts. In exchange, they receive a claim on Baring's assets: the Argentine bonds, the railway securities, the government paper. Assets everyone knows are worthless. But the alternative is worse. If Baring defaults, every bank in the room will face margin calls from their own creditors. Because British banks are interconnected. Baring owes money to Rothschild. Rothschild owes money to Glyn Mills. Glyn Mills owes money to the Bank of England. It's a web of mutual exposure, and if one thread snaps, the entire web collapses, so they pay the ransom. By 6 p.m. on November 15, the guarantee fund is finalized. By midnight, the Bank of England announces publicly that Baring Brothers' liabilities are secured. The market response is immediate. Relief. The newspapers declared a triumph of British financial solidarity. The Times runs a headline: Bank of England demonstrates unshakable confidence. But behind the scenes, something catastrophic is happening. The gold is leaving. The payday loan mechanics borrowing gold to fake solvency. Here's the problem with the £17 million bailout. That money didn't appear from nowhere. It came from the liquid reserves of Britain's banking system, reserves that were already stretched thin. And the moment those reserves drop, foreign investors notice, because the gold standard is a confidence game. People hold British pounds because they believe at any moment they can convert those pounds into gold. But if Britain's gold reserves drop too low, that belief evaporates. And by late November 1890, Britain's gold reserves are dropping fast. On November 1, £28 million. On November 15, £21 million. On November 30th, £17 million. The Bank of England is hemorrhaging gold at a rate of nearly £500,000 per day. Why? Because the Baring bailout sent a signal, not the signal the bank intended. We are strong enough to save our banks. But a different signal. We had to drain our reserves to save one bank. Foreign investors, especially French and German banks, see the reserve drop, and they start converting pounds into gold. Not because they doubt Britain will honor convertibility, but because they doubt Britain can honor convertibility if another crisis hits, so they pull their money out. Quietly, politely, but relentlessly. And Lidderdale faces a nightmare scenario. He saved Baring Brothers, but in doing so, he's triggered a slow-motion run on the Bank of England. The French solution: borrowing credibility from your rival. By early December, Lidderdale realizes he has no choice. He has to borrow gold, not from British sources, those are tapped out, from foreign central banks, specifically the Banque de France. This is humiliating. Britain, the empire that controls a quarter of the earth, is asking France for a loan. But Lidderdale has no alternative. If British gold reserves drop below £15 million, the market will panic. So he travels to Paris. He meets with the governor of the Banque de France, and he negotiates the most embarrassing transaction in British financial history. France agrees to lend Britain £3 million in gold, at interest, with the explicit understanding that Britain will repay within 6 months, and that if Britain defaults, France will publicly announce the loan. This is financial blackmail. But Lidderdale accepts, because the alternative is suspending the gold standard. And suspending the gold standard means the end of the British Empire as a financial superpower. The gold shipment arrives in London on December 12, 1890. It's transported under armed guard from Dover to the Bank of England's vaults. And for a brief moment, Britain's reserves stabilize at £19 million. But the underlying problem hasn't been solved. The bailout didn't fix Baring's insolvency. It just transferred the insolvency from one institution to the entire system. The dead treadmill, every rescue requiring a bigger rescue. By January 1891, the pattern is clear. Every week, foreign depositors withdraw more gold. Every week, the Bank of England has to borrow more from France and Russia to replace it. Every month, the interest payments on those foreign loans compound. This is the payday loan spiral. Britain is borrowing gold to maintain the appearance of solvency, but that borrowed gold costs money. Money that has to be paid back with interest. Interest that drains resources from productive investment. And the entire time, the underlying problem, the £21 million in worthless Argentine bonds, remains unresolved. Baring Brothers has been restructured. But restructuring doesn't make bad assets good. It just spreads the loss across more balance sheets. The physical decay, investment diverted from infrastructure to bailouts. Here's where the long-term damage begins. In 1889, Britain was investing heavily in infrastructure. New railways in India, telegraph lines across Africa, port expansions in Canada. These investments generated returns, economic growth, trade revenue, strategic positioning. But in 1891, that investment capital vanishes. Why? Because every pound that might have gone to building a railway in Bombay is instead going to cover the Baring bailout. Every shilling that might have upgraded the Royal Navy is instead paying interest to the Banque de France. The empire is eating its seed corn, and the consequences won't be visible for years, but they're catastrophic. By 1900, British infrastructure investment has fallen by 30% compared to 1889 levels. By 1910, Germany has overtaken Britain in steel production, chemical manufacturing, and electrical engineering. By 1914, when World War I begins, Britain's industrial base is weaker than it should have been. Not because of inevitable decline, because capital that should have gone to modernization went to covering Argentine railway bonds that never generated a single pound of profit. This is the hidden cost of financial crises, not the immediate panic. The decade of foregone investment, the Imperial consequence, the 24-year countdown to W. Boyne. Here's the connection no one talks about. When Britain enters World War I in August 1914, it does so with a financial system that's never fully recovered. March 1891, 4 months after the bailout. The Bank of England boardroom. The creditor committee has gathered to decide Baring Brothers' fate. On the table, the final audit of Baring's assets. After 4 months of forensic accounting, the verdict is clear. Of the £21 million in Argentine securities, maybe £4 million will ever be recovered. That's an 81% loss, the worst investment performance in British banking history. William Lidderdale reads the number aloud. £4 million. The room is silent. Because everyone understands what this means. The £17 million bailout didn't save Baring Brothers. It delayed the funeral. And now, the funeral must proceed. The liquidation decision, dissolving a dynasty. One of the Rothschild partners speaks. We have 3 options. First, continue the bailout indefinitely, hoping Argentina recovers. Second, liquidate Baring Brothers entirely, distribute the assets, and accept the losses. Third, restructure Baring as a limited liability company, strip the family of control, and operate it under permanent supervision. Lidderdale doesn't hesitate. Option 3. If we liquidate entirely, we signal that British banks can die. If we continue the bailout, we signal that British banks are on permanent life support. But if we restructure, we send a different message. British institutions survive, but incompetent management does not. And so, the decision is made. Baring Brothers, the 128-year-old dynasty that financed empires, will be dissolved. The partnership is terminated. The family's control is ended, and a new entity is created. Baring Brothers and Company Limited, not a partnership. A limited liability company, supervised by a committee of creditors, managed by professional bankers, not aristocrats. The Baring name remains. But the Baring family's authority is dead. The symbolic death, what the restructuring meant. In Victorian Britain, this was more than a corporate restructuring. This was a public execution, because merchant banks were not just businesses, they were family legacies. Multi-generational institutions where control passed from father to son, where the family name on the door was worth more than the assets in the vault. And Baring Brothers had been that institution longer than almost anyone. Founded in 1762, survived the Napoleonic Wars, financed the British victory at Waterloo, funded the expansion of the empire across 5 continents, and now, in March 1891, that legacy was being terminated, not by war, not by revolution, but by arithmetic. The ledger had mutinied, and when numbers revolt, aristocracy cannot save you. Lord Revelstoke was informed of the decision in a private meeting. He was offered a position on the new board, ceremonial, powerless, a name on letterhead with no authority. He declined. By April 1891, he had resigned from all positions in the City of London. By 1892, he was living in semi-retirement in the countryside. By 1897, he was dead according to some accounts, from stress-induced illness. The prestige trap had consumed him completely. The global contagion, markets from New York to Berlin, freeze. But the restructuring had consequences far beyond one family. Because when the news broke that Baring Brothers had been forcibly restructured, markets around the world seized up. Not because Baring mattered to daily commerce, but because of what Baring represented. If the most prestigious bank in London could fail, what couldn't fail? In New York, stock prices dropped 8% in a single day. In Berlin, bond yields spiked as investors fled to German government securities. In Paris, the bourse suspended trading temporarily due to technical difficulties, a polite euphemism for panic. And in Buenos Aires, the crisis accelerated into full economic collapse. The Argentine government defaulted not just on Baring's bonds, but on all foreign debt. The peso lost 60% of its value within 6 weeks. Unemployment hit 25%, and the nation that British investors had called the next United States descended into a depression that would last a decade. The contagion was complete. One bank's failure in London triggered sovereign default in South America, market crashes in North America, and liquidity freezes in Europe. This was the first modern demonstration of systemic risk. The understanding that in a globalized financial system, no failure is isolated. Every institution is connected. Every default ripples outward. And the system is only as strong as its weakest link. The trust fracture. Foreign investors questioned London for the first time. But the deeper damage wasn't economic, it was psychological. Before November 1890, investing in London was considered nearly risk-free. The British Empire had 2 centuries of financial stability. The gold standard had never been suspended in peacetime. British banks were synonymous with reliability. But after Baring, that certainty evaporated. Foreign investors, especially French and German banks, began asking questions they'd never asked before. If Baring could hide £21 million in bad debt, what are the other banks hiding? If the Bank of England had to organize an emergency bailout, how many more bailouts can it afford? If British banks are over-leveraged on South American debt, what happens when the next South American country defaults? These weren't paranoid questions. These were rational questions. And they changed the calculus of international investment. Before 1890, British government bonds gilts traded at a premium. Investors accepted lower yields because of the perceived safety. After 1890, that premium shrank. Not dramatically, just 0.3% to 0.5%. But in global finance, that's a signal. It means the market is pricing in risk that didn't exist before. And it means Britain now has to pay more to borrow money, which means less capital available for infrastructure, military expansion, and colonial development. The hidden cost of the Baring crisis, Britain's borrowing costs increased permanently, not because of the bailout itself, but because of what the bailout revealed about British financial fragility. The hidden victory, crisis contained, but the myth dead. Here's the paradox. In the narrow sense, the bailout succeeded. Baring didn't default. The gold standard survived. The Bank of England maintained convertibility. Foreign depositors didn't panic en masse, and by 1895, the immediate crisis was over. But in the broader sense, Britain lost something irreplaceable: the myth of invincibility. Before 1890, British financial dominance was assumed. After 1890, it was questioned. Before 1890, lending to British banks was considered inherently safe. After 1890, it required due diligence. Before 1890, the City of London was the unquestioned center of global finance. After 1890, it had competition. New York began attracting capital that once flowed automatically to London. Berlin emerged as a rival financial hub. Paris gained credibility as a lender of last resort, ironic, since France had to bail out Britain. The crisis was contained, but the empire's prestige, the intangible asset that made British finance dominant, was permanently damaged. And prestige, once lost, cannot be recovered through bailouts. The autopsy, what Baring's liquidation revealed about Imperial overstretch. When historians later analyzed the Baring crisis, they found a disturbing pattern. Baring Brothers wasn't an outlier. It was a symptom. Multiple British banks were over-leveraged on colonial and South American debt. Multiple institutions were paying dividends with borrowed money. Multiple firms were hiding losses to maintain their reputations. Baring was just the first to break. But the structural problems were systemic. The British Empire had been operating on a dangerous assumption: infinite expansion financed by infinite credit. Build railways everywhere. Lend to everyone. Assume commodity prices will rise forever. Assume debtor nations will always pay. Assume credibility can substitute for capital. And when that assumption failed, when Argentina defaulted, the entire scaffolding nearly collapsed. The Bering crisis revealed the truth. Britain's global dominance was more fragile than anyone believed. The gold reserves were too thin. The banks were too leveraged. The credibility was too dependent on never being tested. And once tested, the empire would never be the same. The final image: an empty vault. March 20th, 1891, the last day of Baring Brothers as a partnership. The clerks are boxing up documents. The partners are signing the dissolution papers, and in the vault beneath 8 Bishopsgate Street, a junior clerk takes inventory of the remaining assets. He opens the drawer labeled Argentine Securities Category A. Inside, stacks of bond certificates, beautiful engravings of railways and government seals, legal promises worth £21 million on paper and maybe £4 million in reality. He closes the drawer. And in that moment-to-moment witnessed by no one important, the British Empire's financial dominance ends. Not with drama, not with speeches, just a clerk closing a drawer on worthless paper. The empire would survive another 60 years. But the myth that sustained it, the belief that British finance was invincible, died in that vault. And without that myth, the empire was just another nation. Powerful, but mortal. Rich, but fragile. And already counting down to the crisis that would finish what Argentina started. There are two Britons in history, the Britain of 1889 and the Britain of 1891. They look identical. Same queen, same parliament, same empire stretching across the globe, but they are not the same nation. The Britain of 1889 believed in its own permanence. The Britain of 1891 knew it was mortal, and that knowledge, that crack in the imperial confidence, would grow wider every year until it swallowed the empire whole. The historians who write about the collapse of British dominance usually point to 1914, the Great War, the industrial slaughter that bankrupted Europe, the moment America became the world's creditor and Britain became the debtor. But they're looking at the wrong date. The empire didn't die in 1914. It died in 1890. World War I was just the autopsy, the 24-year countdown. How 1890, creating 1914's vulnerability. Here's what no one wants to admit. When Britain entered World War I, it was already financially fragile, not because of bad luck, because of choices made 24 years earlier. The Baring bailout of 1890 established a template: privatized profits, socialized losses. British banks learned they could take reckless risks because the state would rescue them, so they did. Between 1891 and 1914, British banks continued overlending to unstable foreign governments. They continued paying dividends even when profits didn't justify them. They continued prioritizing prestige over prudence. And when war broke out in August 1914, Britain discovered something horrifying. Its financial system couldn't handle the stress. Within 6 months, Britain had to suspend full gold convertibility. Within a year, it was borrowing from the United States. Within 2 years, it was liquidating overseas assets to pay for weapons. And by 1918, Britain owed more to America than it had ever owed to anyone in its history. The war didn't cause this weakness. The war exposed it. The weakness was built into the system in November 1890, when Britain chose to bail out Baring Brothers instead of reforming the culture that created the crisis. The two nations, confidence versus fragility, walk through London in July 1889. The streets are confident. The architecture proclaims permanence. The bankers speak in certainties. The British Empire will last 1,000 years. The gold standard is eternal. Our financial institutions are unshakable. Now walk through London in January 1891. The streets look the same, but the conversations have changed. Bankers speak more quietly. Investors ask more questions. And foreign depositors keep a closer eye on their gold reserves. The confidence is gone, replaced by something else. Caution, doubt. The knowledge that what seemed eternal can collapse in 72 hours. This is the psychological legacy of the Baring crisis. Britain survived, but it learned it was survivable. And once an empire knows it can be wounded, it's already dying. The moral maxim: empires don't die in wars, they die in ledgers. There's a lie we tell ourselves about how empires end. We imagine dramatic collapses, barbarians at the gates, fleets burning in harbors, generals surrendering swords. But that's not how empires actually die. They die in ledgers. They die when accountants discover that the numbers don't add up. They die when creditors realize the debts cannot be repaid. They die when the gap between reputation and reality becomes too large to hide. The Roman Empire didn't fall because of barbarians. It fell because it debased its currency, couldn't pay its army, and lost the financial capacity to defend its borders. The Spanish Empire didn't fall because of military defeat. It fell because it spent New World gold on wars instead of infrastructure, and went bankrupt 6 times in a century. And the British Empire didn't fall because of World War I. It fell because it bet its financial credibility on Argentine railway bonds, discovered its gold reserves couldn't cover its bank's losses, and spent 24 years borrowing to maintain an illusion of strength. Wars are the symptoms. Financial exhaustion is the disease, and the disease always starts earlier than the history books admit. The template for 2008, history doesn't repeat, but it rhymes. November 1890, September 2008, 118 years apart, but the same structure. A prestigious financial institution over-leveraged on worthless assets, a government forced to choose between bailout and systemic collapse, a rescue that saves the institution but damages long-term credibility, and a decade of weakness hidden beneath the surface until the next crisis reveals it. Baring Brothers and Lehman Brothers, Argentine railway bonds and mortgage-backed securities, the Bank of England's emergency consortium, and the Federal Reserve's troubled asset relief program. Different names, same mathematics. The 1890 crisis taught us that financial systems are fragile, that prestige cannot substitute for capital, that kicking the can down the road doesn't solve structural problems, that bailouts create moral hazard, and that empires built on borrowed credibility eventually run out of creditors. We learned all of this in 1890, and then we forgot. And then 2008 happened, and we're forgetting again. The final warning: the ledger always wins. Here's the truth that makes economists uncomfortable and politicians furious. You cannot negotiate with arithmetic. You cannot spin insolvency into liquidity. You cannot maintain an empire on credit forever. Eventually, always the ledger wins. You can delay it with bailouts. You can obscure it with accounting tricks. You can deny it with confident speeches. But the numbers don't care about your reputation. They don't care about your history. They don't care about your prestige. They only care about one question: do the assets cover the liabilities? And when the answer is no, everything else is theater. Baring Brothers learned this in November 1890. The British Empire learned this between 1890 and 1945. The world learned this in 2008, and we'll learn it again. Because we always do. Because we always forget that empires don't die in battles. They die in balance sheets. The closing image: the empty vault in Threadneedle Street. Imagine walking into the Bank of England's vault today, down the spiral staircase, through the brass doors, into the chamber where Britain's gold once sat. And in the corner, there's a plaque, small, brass, easy to miss. It reads, "In memory of the Argentine securities held here, 1885 to 1891. Value declared, £21 million. Value realized, £4 million. Now you realized £4 million. No grand monument, no dramatic inscription, just a quiet acknowledgement of the moment the British Empire looked in the mirror and saw a corpse." The gold that should have been in that vault was spent covering railway bonds in Buenos Aires, railways that never turned a profit, railways that still run today, half empty, through provinces that never developed the way Victorian bankers promised they would. The empire survived the Baring crisis, but it spent the next 24 years slowly bleeding out. And when World War I arrived, there was no gold left to stop the hemorrhaging, because the gold had been spent decades earlier, covering the debts of aristocrats who couldn't admit they'd made a mistake, bailing out banks that were too prestigious to fail but too insolvent to save. maintaining an illusion that arithmetic had already disproven. The British Empire didn't die in 1914. It died in 1890. Everything after that was just momentum, and the ledger patient, indifferent, eternal simply waited for the world to notice.